Good afternoon, traders. How are we doing today? It's Wednesday. It's hump day. It's the first day of spring, or maybe it's the second day of spring. And most importantly, I guess, it is FOMC day. Today, we find out, we get to hear from the man himself, Mr. Jerome Powell. He's going to let us know what the heck is on his mind with inflation, with rates, the whole bop shebang. What's up, Gary? What's up, Jammer? How are you guys doing today? Hopefully you're both well. You know, I don't have anything that I really came here to tell you guys to start off with. So, you know, yesterday there was a guest here at the show was asking for some kind of like swing setup. If she's here, let me know. I'd love to like jump into something with you. What's up, David? Hope you're well, sir. Gary, you're out walking around Smyrna. It's 65 and you're on your visible phone service. So it's 65 degrees out in Smyrna today. You know what's actually interesting? My brother lives in Smyrna. So you and my brother might be neighbors. ATLian over here, old school. Spent my whole life there. Yeah, so how are you guys doing today? What are you thinking? What are you expecting? I mean, we know what everybody's expecting. The rates are not going to change, right? That's what everybody's expecting. I was watching this morning. I don't know if any of you guys tune into our friends JC Peretz and the guys over at All Star Charts. Every morning they do a show. And this morning they had a fella, I can't remember the guy's name, from Fundstrat was on, and he was pretty bullish on the idea of like, we are actually going to get rate cuts. We're going to get more rate cuts than people are expecting. He didn't think that we were going to get one today, but he was just saying that like looking out towards the end of the year, we're going to get more than what people are expecting. So I don't know if that's true. I guess maybe we'll get some sort of understanding today from Powell about when to expect the first rate cut, if it's going to come at all. Yeah, is Fundstrat ever not bullish? Of course. I mean, you know, I've heard that for sure. They are always bullish, basically, but it pays to be always bullish, right? In markets that have a tendency just to go up over the long term. You know, I guess it's maybe a little bit easier to be bullish during periods of downturn than it is to be always bearish, right? Because there are some people out there that are just constantly bearish. So, all right. So big dump. David, you really think so? Big dump incoming. Let's take a look at some things. I kind of want to just see. I haven't been paying a ton of attention to the markets over the past couple of weeks. I mean, outside of just kind of the regular old check-in. SPY almost back to another all-time high here on the daily. Where the Q's at. Same idea on the Q. I mean, these things do not look like they are just like about to roll over. IWM, let's take a look. Let me remove some stuff here. IWM coming back into kind of like the breakout area and trying to hold. Yeah, I mean, I don't know. IWM kind of looks the worst of the three. But it's hard to be just overtly bearish on the look of this, despite, you know, the assumption that there just should be a correction at some time. One thing that we thought was kind of interesting, I noted this weekend. This is true on the Qs and on the SPY. Let me change this real quick, just so you can kind of see a little better. This move that we saw from like summer last year into the fall of last year, it's like a 12% move lower. Well, from the current high to where, you know, to the previous all-time high back in 2021, a move similar to this takes us back to those all-time highs, a level that, you know, at some point you would think would need to be powerfully retested. So this is something that we noted in the weekend update this past weekend, that, hey, you know, if we are seeing the potential for price rolling over here. Maybe some sort of multi-month target would be those previous all-time highs. If we go to the SPY, we see a very, very similar thing off of those previous all-time highs. You measure the June move. Oops, it's kind of a little loose, but you measure the June move down to the October, or the June to October move, and you get something pretty similar, right? Price back into those previous all-time highs. So I don't know. Maybe we're cooling off here, but it sure doesn't look like it, really. Yeah, I would agree with you on that. Rate cuts would probably be, I mean, rate cuts would be good for the markets in general, right? But like IWM maybe stands to profit the most from it. Bear to bull bet is 3-1 on 0 DTEs. Yeah, really? Interesting. There's a bunch of you guys here. Pipe in. Come on, join the conversation. Like, what are you guys thinking? How are you trading this? How are you playing it? Are you trading it at all, or are you kind of hanging out, sitting on the sidelines, waiting for things to shake out? I was watching this morning. Well, actually yesterday, we were watching Boeing. I think that I mentioned this in the stream, that Boeing seemed like a reasonable spot where, you know, kind of like a really low risk spot off of those lows. Really nice reversal on Boeing today. You're walking and typing, so don't tell me these people that are sitting at their desk saying nothing. Yeah, exactly, Gary. Exactly. Jason, what's up, man? You feel like bear move is more likely. A bull move would be more extreme. Possible. Sandro, what up, Sandro? You got BA? All right. Hey, let's go. How did you play it, Sandro? Volume on put buying is 3x. Yeah, that's kind of what I figured. Sandro, you're driving. All right, well, you know, some things are more important than tuning into a live stream, Sandro. Pay attention to the road, sir. All right, so I see there are a few of you here. Hopefully, some of you are TrendSpider traders. If you're a TrendSpider trader, thank you so much for being a part of the gang. If you're not yet a TrendSpider trader, you just missed a killer deal. Our St. Patty's Day. We are no longer offering that deal, but you can still save up to 50% off on TrendSpider. Follow the link in the description of this video to access that, up to 50% off on your first year, TrendSpider. The way that we usually do these office hours sessions on FOMC day, just for those of you who are not yet initiated, you've never tuned in, this is your first time, you're scrolling YouTube and you're like, who's this guy talking about FOMC? My name is Jason Krutzky. We are TrendSpider. And the way that we usually do these is there's kind of two things, right, that happen on a day like today. You have the announcement here in about 22 minutes. That announcement will cause the markets to move in some sort of way. Sometimes it's super volatile. Sometimes it's not volatile at all. Sometimes it's, it just somewhere in between. So we will watch the market's initial reaction to the move. We already know what we're expecting. We're expecting rates to stay paused. That's the consensus, like 100% consensus on the street. There's like no wavering with that. But then more importantly, we will tune into the press conference. I will shut up. I will turn the music off, and we will turn Jerome Powell up. We will crank him up, and we'll listen to what he has to say, because what he has to say is seemingly way more important than the news that we're going to get here in 22 minutes, because everybody knows the news. Everybody knows what's going to happen, but they don't know what he's going to say. Is he going to come off more dovish? Is he going to come off more hawkish? Is he going to present the idea that, hey, we're not going to get a rate cut until September of this year? Or is he going to say the same thing that he kind of always does and diverts, and he's got his, he's got his shield up, and he's just going to field the questions and not say much. We don't know what he's going to say. So that's why we tune in, because we want to know. So that will happen at 2:30 Eastern time. So in between now and then, there's a couple things that I always like to do. The first thing I like to do is I'd like to offer you guys the opportunity to pick the charts that we watch while the announcement takes place. We can utilize TrendSpider's multi-symbol view for that, and I will jump over to that chart in a few minutes once we're a little bit closer to the announcement. While we're waiting for the announcement, if you guys want to go ahead and get your charts in the chat, let me know what charts you want to see. We can watch up to 16 at one time. So, you know, if you're in a trade and you want to monitor that trade, but you're watching this live stream, we can throw that chart up for you if you'd like. So let's do that. Get your chart requests in. Let me see here. David, Sandra, 190Cs on BA, huh? What did I get this morning? Yeah, same. Wasn't sure what I got. 190C. Cool. We're on the same idea. What's up, Chip? Yep. So one thing, we do always throw up the Qs. We always throw up the SPY. We throw up the IWM. I like to throw in some crypto in there. Bitcoin, Ethereum. Also, you know, a lot of the tech names are kind of going to do similar things. So if y'all want to see like Nvidia and Apple and Microsoft and Google and whatever, we'll probably just like put one of them up. I like to try and mix it up. You know, let's look at oil. Yesterday, we talked about seasonal strength in oil names in April during election cycles. Do you remember that? Oh, yeah, I could do the composite chart. Yeah, the Mag 7 comp chart. Is that what you're saying? Clean Spark. You know, I've been hearing about the, isn't Clean Spark solar? I don't really pay too much attention to solar names. I had heard that solar names were getting like totally rocked, but this one is doing quite well. I don't even know solar names. What am I doing? Let me look up Clean Spark. Oh, Clean Spark is a Bitcoin miner. Ha! I was way off. It's the best Bitcoin miner. Interesting. Yeah, Bitcoin miners have been getting rocked, huh? Presumably. Maybe you can help answer this question for me, GS, because I'm kind of curious about this too. What I'm assuming about Bitcoin miners selling off is the halving is going to eat into profits, right? That's kind of the whole idea. Can you confirm that? We've got the halving coming up on Bitcoin. Let me see when that is. I think it's like mid-April. Yeah, April 20. Ah, that's funny. 420. So yeah, Bitcoin halving on 420. How does the halving work? Well, the halving is basically just taking the amount of Bitcoin that are awarded every single block and halving them. So right now, Bitcoin miners that successfully validate a transaction are currently awarded 6.25 new Bitcoin each mined block. The halving will reduce that reward to 3.125 Bitcoin. Yep. All right. That's what I figured, GS. So the only thing that can kind of counter that fear is Bitcoin increasing in price. GS, do you think that it's possible that the crypto markets are selling off now to kind of like balance the potential of a really powerful move post halving? Because this has been kind of my theory. Sell off crypto into the halving, scare everybody out, you know, make it scary. Sol's down, what, 18%? Ethereum's down almost 25%. or was down almost 25% from 4,000 to like 3,100. Bitcoin kind of hanging in the best of all of them, I believe. What's Bitcoin trading at? Bitcoin's trading 64,000 right now. So that's kind of been my thinking. Like, if the rewards are decreasing by half, that's half the amount of supply that's coming onto the market every block. Now, I don't know how often a block gets mined. Maybe GS, maybe you know. Is that every day? Is that every week? I'm not sure. But if half of the amount of new supply is coming into the market every day, and the desire for crypto assets, specifically Bitcoin, continues to increase or even stays steady, I mean, come on. You got to assume price of Bitcoin's going up, right? I know that didn't BlackRock just liquidate some Bitcoin not too long ago, like yesterday? I'd have to look into that. I know that I kind of like saw the headline. All right, so we got CLSK. We've got a couple of tech names. Let me throw up multi-symbol view here. We got about 14 minutes until this goes down, so let me go ahead and get some things going. Let's remove some stuff here. All right, so I'm going to put Qs right here. And I'm going to go small time frame. We want to see the actual reaction. Let me turn off extended hours. What about bond ETFs? Give me a ticker. That is so outside of my wheelhouse, Gary. Talking like TLT. TLT. Yeah, you know, Chewy, give me a break. I watch a lot of things. But yes, I will throw up TLT for sure. I will put it right here. Chewy, how are you doing today, man? Are you doing well? What are you trading today? What are you thinking? How are you feeling about today's announcement? Are you bullish, bearish, couldn't care less? What are you thinking? I'm gonna put some Bitcoin right here. I'm gonna put some Ethereum right here. Do you think Bitcoin, Ethereum is plenty? I mean, what happens to them is gonna happen across the market, so I say we just leave it at that. Socks, we could do that. Actually, socks is a good, I mean, oops, there we go. Socks is a good one. Let's throw up some clean spark here. What else, guys? AMD gang? Sayo, what's up, man? Hope you're well. All right, so I'm gonna put AMD in here for now. This might be one that we change to some alternative style of asset. Y'all want to do like oil, maybe? Kind of feel like oil might be worth watching. USO or XOM or something like that. Maybe USO for now. USD. So, yeah. So let's do, shoot, what's that ticker? We do not have DXY on the platform, unfortunately. I wish that we did. We have the ETF. Hold on. Just trying to remember what it's called. UCO? UUP, that's it. All right, here's the dollar index. UUP. Thank you, Chewy. Mr. M has priced in 6 to 7 rate cuts this year. We may get 1 or 2. Do you think... All right, Clifford. Clifford, that's this guy right here, UUP. Do you think that... I know that that's the narrative. The market has priced in 6 or 7 rate cuts this year. But don't you think that they've revised that down at this point? Don't you think it's like very common knowledge that 6 or 7 rate cuts ain't happening? Chewy? And if that's the case and the markets are still where they are, do you think that the markets actually have priced it in? Like, I know that was the narrative at the beginning of the year, but we're in March and the narrative right now is June is going to be the first one. If June's going to be the first one and the market knows it, how come the market is trading? Like, does the market care about 6 or 7 cuts, I guess? Or do you think that the market is still expecting 6 or 7 cuts, but for them just to start in June and continue essentially every month until the end of the year? That doesn't seem realistic to me. I am no expert. That's for sure. When it comes to this sort of stuff, I am no expert. But it just doesn't seem realistic. So either the market doesn't care or the market is about to like get rocked. Is kind of what it feels like. Like, those are the only 2 options. Either it doesn't care and it just kind of continues grinding slowly higher, or it does care and something is kind of holding it up and is going to pull the plug on all of the bullish fun here sooner than later. I mean, maybe we'll get something like that out of Powell today. You know, maybe he'll say something that like really scares everybody, but I don't know. I'm just realizing I missed something from GS. GS, you said now the miners are accumulating Bitcoin. They will have to sell some Bitcoin to keep the hash rate up by investing in new miner hardware. The market waits to see the new earnings after halving. Interesting. Chewy, spending is strong. Job market is strong. How can Powell justify cutting rates? I mean, I don't know. I don't know how he can. I do know that historically, the Fed does not look at the market. The Fed doesn't care about the market. They care about the bottom line. And the market is not part of their thing. What's up, Naresh? You want to keep an eye on snow? This one sure was looking interesting until their CEO stepped down. Oh, man. Look at them. I drew this level some time ago. Ah, how come? Oh, man, I missed it. It came yesterday. How did I miss it? Naresh, I needed you here yesterday to mention this. Dang. All right, well, we'll watch it. They came right to the spot. No, Naresh, it's okay. I'm just messing. That's not your responsibility. What I should have utilized is Alerts. Yeah, Chip. Right. What am I doing? I deserve to miss it. I deserve to miss it. If I don't put an alert on that level, I deserve to not be alerted. I deserve to not know. What's up? Why not? Hope you're well today. All right, we got 3 more panels here that we can fill. This one behind my head is kind of useless. You won't be able to really watch it. But we're gonna get an announcement here in 4 or 5 minutes. So we're gonna get some sort of reaction. What about gold? Maybe? Let's throw gold on there. GLD. All right, we can add NVIDIA. I do have AMD and I do have I do have SOX too. So again, like I said, I'll throw up NVIDIA on there. If any other requests come in, I might switch out one of those 3 for another request. Naresh, CLDX. So this I don't know a thing about. To 17. Yeah, you think this is like a failed new high and they're going to go make new lows? Oh, CDLX. Oops. My bad. Big move over the past couple of days on this one. Chewy, we've got ETH. ETH is right here, sir. Got ETH and Bitcoin. Any others? Buyout can happen in this, and Piton Lulu will consume Piton before year end. Yeah, you think so? TNX. I got TLT up here. The thing about TNX is that it's delayed. Excuse me. So it won't really serve us too well. Is the problem there. Like we have it. But it's an index, and all index charts are 15-minute delay. So will TLT rather serve you the same? Ah, James. Yeah, we could do FUTs if you want. Yeah, VIX. We can look at VIX. I'm going to replace NVIDIA with VIX. Naresh. The reason why is because I already have AMD and SOX and QQQ. And generally speaking, they're all kind of going to do the same thing, right? But AMD is kind of part of SOX, right? So maybe I could put Meta instead of AMD. It's looking pretty good so far. Yeah, I use VIXI, James. Short term. BTAH. What's BTAH? Or is that bra? Yeah. You just spelled bra wrong. Okay. Meta is also a meme purveyor. TrendSpider got options, bro. That's right. Well, then let's do this. Instead of ETH. Well, no, ETH was requested. I'll leave it. All right, so initial move. Higher. Gold higher. Index is higher. Ooh, IWM. VIXY dumping. So, of course, as everybody knew, no rate cuts. They're holding rates, leaving them unchanged. Jerome Powell and the Fed still project that there will be 0.75%, 75 basis points of cuts this year. That's at the most, that's 3, right? That's 3 1/4 each. What's up, everybody who's here and tuned in? Thank you so much for being here. If this is your first time to a TrendSpider Office Hours, welcome. Today we are watching the market's reaction to the FOMC announcement. In 30 minutes, we will be tuning in to the Jerome Powell press conference. Please stick with us. If you intend to watch the press conference, because we're going to be tuned in here, in between now and then, if you have questions, oil seems to not care about this move. The dollar taking a little bit of a nosedive. Gold doing good. Bitcoin moving a little. Well, no, not really. It's really all about the indexes, huh? And IWM in particular. If you are tuned in for the first time and you have questions about TrendSpider, that's why we're here. That's why we do these things. Not only are we going to be watching Jerome Powell's presser, I'm here to answer questions. So if you are curious about anything TrendSpider related in between now and the next 28 minutes, hit me with those questions. We can answer them for you. Girl Trader, you're back. If you want to talk about your idea from yesterday, we definitely can. If you wanted to give me a bit more info. Yeah, so, okay. So, the market knew this was going to happen, right? The market knew no rate cut. The market is pleased so far. Of course, we've all been here before. We've seen this happen many a time. Market moves in one direction. As soon as Jerome Powell starts talking, it moves in another direction. And then as soon as he stops talking, it moves in another direction. So if you're trading this, kudos to you. Best of luck. I wish you the best. I'm not going to be trading this. Excuse me. But if you'd like to look at some charts in between now and his presser, we can do that. If you want to talk about TrendSpider tools, we can do that. I'm all yours for the next 26 minutes. Or we could just sit here and hang out and talk about whatever you guys want to talk about. So y'all tell me. If you're here and you got questions, do you guys have an active Discord channel? Paul, great question. Yes, we do. Click on the, oops, not there. Click on the question mark right here and go to join our official Discord server. In fact, Paul, if you are not yet a TrendSpider trader, I believe this is still open. It won't be open for long, I don't think. But there's your link. Naresh, you got a target of 532 on Lulu tomorrow post ER. Have you done any testing of the ER moves? Excuse me. Because we can take a look at it. Check this out. I don't know if you've played around with this yet. We did this yesterday. I'm going to go to Lulu here. So you can actually test the moves if you want to. Like, for example, if you wanted to test, I don't know, the move after an earnings announcement, you can come in here and you can say earnings dates are today. And then you can say number of candles passed, like 10. And test and see how it tends to move post earnings. 47 positions, 49% win rate. Average win, 5.29%. Average return, this is really the key number here, 0.51% 10 days post earnings. Over the past 47 earnings announcements. You could, if you wanted to, you could say like earnings dates within the next 1 day. So like getting in right before earnings and then holding it. A little bit better, average return, 4.59% on average across 44 positions. 70% win rate. Interesting. Interesting. You're expecting a big move, Naresh. 532 from 465. So you're essentially expecting a new high. How quickly are you expecting that to come? It's a 14% move. We could, let's do this. I'm going to throw up some seasonality and just kind of see. Yeah, March is an okay month for Lulu. Actually, highest mean change historically for Lulu since 2007 comes in March. 8.38% mean change on Lulu. That's from previous month's close to March close. So let's do something here. Where are we at right now? So we're down. We're currently down 0.482%. So that average, whatever, 8.2, what do we say? Brings us up to about $508. Interesting. You do not lose in this name. Listen to Naresh. Flexing. All right, so again, if this is your first time here and you are, enjoying the show so far and you're interested in TrendSpider a little bit, or you're interested in perhaps tuning into future TrendSpider office hours shows, hit me with a subscribe, you guys. Hit me with a subscribe. Hit me with a like. Give me some love. We try and do these a couple times a week. Sometimes it's Monday, Wednesday, Friday. Sometimes it's Tuesday, Wednesday, Fridays. We kind of like to mix it up. I like to mix it up. We can see past fundamental data. So I'm actually working on the announcement for this now, but I can show you guys. Check this. In your other data button, underneath your other data button, Click on the three dots, and now you can add fundamentals. And inside fundamentals, if you click on the three dots, you've got this little search box here. So we could say like EPS. Well, let me say earnings. EPS and all these things. Let me also direct you to one other spot. Actually, we could do it here. And this would be good for you guys to know. If you click on this question mark and you go to read docs and knowledge and you type in fundamentals, click on that first article. This is the docs and knowledge base is particularly helpful if you're relatively new to the platform, you're having trouble finding something. You can almost always find a little bit of something about everything inside the knowledge base. So here are all of the fundamental data points that you can now visualize on TrendSpider. And this is just the first step of it, incorporating them onto your chart via this lower indicator here. This is going to get quite more robust over time, but this is the beginning. This is the start of that information, or that set of information, and how you'll be able to utilize it on the platform. This is a big deal. You know, technicals, we love our technicals here at TrendSpider. You know, if you're a trader, if you're a day trader, you're not trading on fundamentals, you're trading on technicals. But if you are a swing trader, you're holding for several months maybe, or you're looking for long-term positions, fundamentals might really matter to you. And we've always had a bit of fundamental data, but now we're getting like the serious, deep business fundamental stuff. So this is a pretty cool addition. We're going to be announcing this probably next week or maybe this weekend. But you guys are here, so why not tell you? Naresh, DWAC plus Trump and Elon has something cooking here. Yeah, you think so? Ooh, does kind of look like it, doesn't it? You know, the thing that I had found was this. From the previous move, why they paused it kind of where they have so far is from the previous move, your anchored view app from that move is right here. So you got a bunch of people. Yeah, you got a ton of people who have bought down here, but they're meeting sellers who were trapped up here. What's up, John? Hope you're well. You know, that's an interesting thought, because think about this too. Like Elon is a meme expert. Elon understands the power of just people talking. And gosh, what's going to get conversations flowing later on this year once the election cycle is like really kicked into high gear? People are going to be talking about Trump. And Elon's going to want that conversation happening on Twitter, presumably, right? He would prefer that conversation happening on Twitter than Trump's DWAC. So what do you think is gonna happen? Naresh, do you think that like Elon's gonna buy Truth Social? Is that where your head's at? Or do you think that Elon's just going to try and get Trump to come back to Twitter? Conspiracy theories allowed. How are things looking right now? Market's hanging in a little bit. Bonds selling off. Cryptos holding in also. Gold holding in. He'll help Trump with bond money. Really? You think so? That's interesting. What's the story there? I don't know too much about that. $454 million bond. And so the story here, I kind of was like reading a little bit about this earlier today because I saw that Mark Cuban was trending, and Mark Cuban kind of like defended him a little bit, saying, you know, most of his net worth is tied up in office space. Office space is obviously struggling right now. And so getting money, like the amount of money that Trump, quote unquote, has available to him is not anywhere near like what his quote unquote net worth might be. I don't know. He gets a percentage on an IPO. Hey, thanks for the likes, y'all. If you're not subscribed to the channel, hit me with the subscribe. Let's take a look at HD here. Does not quite look like it's prepared to do that yet. Just checking out some things really quick. Gary, I'm looking at your picture of your neighborhood. Looks like Atlanta. And it always gets stuck on this song. All right, we are what? We're 13 minutes away from the big announcement, press conference from Jerome Powell. Let's go ahead and get this guy cracking, loaded up here. Do not want to miss this. In the meantime, while we wait, Naresh, you're coming into some seasonal strength here. Second strongest month of the year is April, historically, since 81. One of the strongest weeks of the year is coming too, in just a couple of weeks. Why do you think it's going to dump? Girl Trader just scalped 3 stocks. Was it 3 wins? I sure hope so. Three wins. Let's go. Nice work. HIMS, PLTR, and DKNG. Nice job. Dang. Look at this revenue curve. Holy moly. HIMS. That's pretty sick. Ooh, I'm going to take a picture of this. I might need this. Not every day you see revenue curves that look like this. Ooh, I need to switch this song. It always gets stuck on this song. I don't know why. There we go. PLTR, pretty as well. He said DKNG. Yeah, March Madness. Ooh. Yeah, wow, this is nice and clean. Yeah, wow, look at this. That's just pretty. The old Weinstein stage 2. Just perfect retests of the 30-week SMA here. Wow, this is pretty. This is like textbook for sure. If you don't know anything about Weinstein stage analysis, I strongly recommend checking it out. It's a really cool way of kind of gauging where you are in the mix of things. This is just a perfect explanation of it, this whole chart, right? You got essentially stage 2 is when price is kind of riding the 30 higher. The 30's trending higher, price is just trading above it. And when price comes into it, testing it really perfectly, cleanly, making new highs. Stage 3, you start kind of consolidating sideways. You see a break below the 30, right? Kind of what we see all in here. This is stage 4. Stage 4 is the opposite of stage 2, right? Price trending below a downward sloping 30-week SMA. And then you have stage 1, the base building. You have the base, it breaks out, it consolidates, it makes a new high, consolidates, and then it stays above the 30-week. Wow, this is so clean. It's very pretty. It's a great looking chart. How would you use anchored VWAP on this chart? Well, I mean, it depends on your time frame, right? So if you are thinking about like, yeah. If you're thinking about, some sort of like long-term trade on DKNG, you know, let's pretend like all of this hadn't existed. Let's pretend that we were like somewhere in here and none of this had happened yet. Where my head would be at is from the highs, I'd be anchoring a VWAP to the high and then looking for, you know, that would be like additional confirmation for me. This right here. So like this, if you were thinking long-term, super long-term, and you wanted to include anchored VWAP in this like Weinstein stage analysis idea, your initial buys would be, your risky buys would be somewhere in here as it's flagging above the 30 and using the 30 as your risk off spot, right? You'd be getting out of this trade on closes below the 30. If you wanted to incorporate the anchored VWAP and you said, oh, I don't want to be in this trade unless price is able to like really get above this anchored VWAP, then it did exactly what you would have wanted it to do within the Weinstein stage analysis part, right? It broke out, it flags, breaks higher, flags, breaks higher, flags. And on this break, you break above the anchored VWAP from the highs, which means now your average buyer is in the money. Everybody who bought from the highs is now in the money. And then it flags, tests that 30-week SMA just as clean as you could do it, really. I bet that there was an earnings date here, too. Let's see if I'm right. Huh? Yeah, there was. Yeah, so they broke out on this earnings. They spent that whole quarter just consolidating above the anchored VWAP, above the 30-week SMA. The next earnings report comes out, and that's when they push it. So if you wanted to utilize the anchored VWAP in that way, like if you're thinking about a long-term swing trade, that's how I do it. If you were just day trading, then I would be kind of the mindset of, I like utilizing anchored VWAPs from multiple days back. So like 2 or 3 sessions is kind of the way that I think about it. There isn't a right or a wrong, but like, you know, here's 2 sessions back, anchored VWAP. We didn't really get too much action on that one. We could check this one too and see. Yeah, no real action there on that one. Another thought for you. I would also recommend, if you're interested in anchored VWAPs, you might also be interested in this tool. So this is the volume by price drawing tool. There's a couple of different ways that we can use this. But volume by price drawing tool, you can draw a volume by price, like a volume distribution across a section of the chart. So you could theoretically draw these for each day. There's also this indicator, per session volume by price. And this is the same idea. So this is a volume distribution across every single individual session. Yep. This is volume profile for each session. And on small time frames, the way that I use this is I look for untested points of control. So on your per session volume by price, you've got a purple line called the point of control, POC. Oops, I didn't mean to just, okay, yeah. And that, when you have untested points of control, you want to look for those areas to potentially come in and act as support or resistance during future sessions. So like, here's an example. So on this particular day, you have this move, you create this point of control right here. And it never gets tested, right? Your next day, you're trading well under it. The next day, you're trading well under it. And then they test it. So initially, you have a trade right here. And you can see in the wick of the candle, they did it. It was very quick. But that candle right there tests that point of control and initially sells off. Well, they're able to gain it. Then they bounce off of it, hold it as support, right? So there's another trade right here. And vice versa, and again right here. See how they're using it as support resistance like multiple times? So another thought, then like another untested spot, in theory, not even in theory, it just is untested so far, is like right here. Right, yesterday's point of control has not been tested yet. So then maybe, you know, tomorrow, maybe the next day, maybe they come in and they try and test this. And you potentially watch it for a long opportunity. Honestly, this is, to me, this is like huge. Look at these. You have 2 days right here. Points of control in the exact same spot. Never really gets tested as this push up on the 18th. What did they do on the 19th, though? Look at the perfect test. Right there. It was the points of control from the previous sessions that hadn't been tested yet. And you could just go back in time and look. You'll see it. You'll see it a lot. Here's kind of a similar scenario. You've got points of control here that weren't quite tested from these two sessions. They actually tested it here and held. And then when they broke back through it, just ghosted through it here, they test it right here. They test it right here. Really powerful. Really powerful. I use per session volume by price a lot. Yeah. All right, so let's go back to multi-symbol view. We've got, gosh, only just 2 minutes left here until the presser. So I'm probably gonna be shutting up here in a second. I'm gonna do something. Yeah, so Girl Trader, speaking of the voice channel, I might in the future, what I might do, particularly if we take our Discord channel private, what I might do is I might start doing these. Okay, we got Powell. Let me turn off my music. Bear with me. Uh-oh. Oh no. YouTube. Don't do this to me, YouTube. Oh no. Say it ain't so. Guys, I'm sorry. YouTube is rugging me. All right. Let's see. We almost got rugged, but we didn't. Y'all, let me know if, once he starts talking, let me know if the volume is not loud enough.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply.
No. Not good. You guys, we're getting rugged.
Supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, Slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings, consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you. Microphone. Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well, and the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down, and so.
When you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so. I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
And will you be able to get overall inflation down to target if housing doesn't break through quickly? And does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and people's working lives. And so, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't.
What he just said was pretty bullish.
Excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision, and we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and say May to be able to get the kind of confidence that you say that you still need, or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, just a question of, is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back. Unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Rieger at Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero. in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%.
Yes, it did. Girl
toward
trader.
2%.
Intraday, new all-time high.
Gina Smilik, The New York Times. Thank you for taking our questions. Per your comment to Ann that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now? And in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying, we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and you can, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now, and we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than 1% before you begin cutting rates? Thank you.
We're very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem. We've always had dissents, and so you respect thoughtful dissents very much. It's like you may not agree with some arguments, but you really want to understand them. So you may read a book that takes a position that you have long opposed, just to understand that book. So I treat dissents with real respect as well.
So Simon, one will be available.
Simon Rabinovich with The Economist. Can you hear me?
Yes.
Okay, great. Obviously, inflation is some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, the things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing many other balance sheet issues. We will discuss those in due course. But what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, and that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system. And there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress. And then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's not urgent right now. We want to get this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria.
Hi, Victoria Guido with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops near at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Go to Jean.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask also about the balance sheet. You said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower, you can get farther. But that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks the reserves at a very slow pace. So you have you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and, buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
Are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of a CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that, that Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. You know, it has applications in wholesale finance, in the payment system. And so we to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. You know, I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think, I mean, this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that. So Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8. So now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. I mean, there's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that that is the case. I said that any number of times. So those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year. And what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE coming down by 10% every month, I mean, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on in the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Thank you. They just hard cut him off, didn't they? All right. Well, I mean, seems like that went about as good as it could go. If you're bullish, that went about as good as it could go. Is everybody pleased? Let me get this music going again. Is everybody pleased? Hopefully you guys are pleased, because that was, I mean, that was pretty sweet. I am essentially at time. Girl Trader, you asked about whether or not these sessions were saved. They absolutely are. You can access any office hour session. You can rewatch it if you want to. There are little lessons in all of them for sure. I was also going to let you know, let me grab something for you really quickly. I've done a handful of videos, technical analysis series videos on market structure and on volume. Let me show you. I'm going to just give you some links so that you have them. So this one I would recommend, this supply and demand zones. This one might help you. And then this one too. This one's market structure basics. Let me see if I can find any other ones. Here, this one too. Supply and demand with volume profile is another one that you might be interested in. Those three all could definitely impact and could definitely help you with the volume profile stuff. And again, like I said, I'm happy to talk more in depth about this in a future session. This is one of my favorite kind of things to utilize in my own personal trading. So I've got quite a bit of experience with it. So I'm happy to open up that conversation. Big deal. What are the bears going to say now? They're probably going to say no cuts for the rest of the year. You know, that's probably the next narrative. They're just not going to cut it all. I don't know. We'll have to wait and see. Time will tell. I want to give a big shout out and a big thank you to everybody who stuck around for Jerome Powell's conference. Hopefully that was a bit enlightening for you guys. I was really impressed with what he had to say. You know, he didn't give us any bad news. Markets are clearly liking it. You know, like they're not selling off here after it. It's something to be mindful of. This is a pretty big deal. I hope that we learned a little bit today about TrendSpider. And, you know, as always, thank you guys all for being here. This show is nothing without y'all. So if you've enjoyed it, if you're not yet a subscriber to the channel, go ahead and subscribe. It's obviously free to do that. You'll get alerts every time I go live. I'm going to plan on being live again on Friday at some point in the morning. And yeah, until then, this has been a pleasure. So y'all be good. Trade them well. Holler if you need me. Let me show you this too. Let me give you this. Krutzky Trades. This is my Twitter handle. For anybody who is a TrendSpider trader, if you guys ever have any questions that you want me to like approach in a future office hour session, feel free to hit me up. My DMs are open. I'm happy to field any questions that you guys might have about TrendSpider, or happy to, you know, assist you if you're having any trouble or anything like that. And yeah, you know, come Friday, if you guys are around, join me for another office hour session. We'll be back at it, answering questions about TrendSpider, trying to help you guys understand how to utilize the platform. So until then, take care, everybody. Thank you for being here, and we will see you again next time. Yeah? All right. Bye-bye.